Hello everyone. We are now at episode 12 of Odds Are, your S&P 500 weekly market forecast. All right, we've got some fun stuff for you guys today, and the title of this episode, and yes, I'm starting to move more towards actually giving titles because there are some themes that I'm seeing popping up, and I want to make sure that you guys can identify those easily from the title of the episode. And the title of this week's episode is Pyramids in the Sky. And yes, I will explain that further. In fact, I'll actually show you what I mean. But first, let's take a look at last week's relative view to see where the market ended up and how that compared to our forecasts. All right, so you can see the market still in this like range-bound pattern here. It's not really making much progress. In fact, the close this week was only 2 points off from last week's close. Not a big difference at all. Kind of just ended up where we started. But even more, look back at the last couple of weeks. We've kind of been stuck in this 4120 range up to 4200 for almost about 2.5-3 weeks now, and eventually that's gonna break. There's actually a theory that I have. It's called deviation coils, and so if you can imagine the standard deviation or the variation of the market, right? And as that gets tighter and tighter and tighter, meaning there's less and less and less variation, eventually that pressure builds up, and then the market is going to have to make a decision. We're reaching that critical point where the market has to decide, where are we going from here? Because when it's range bound for too long, eventually the bears or the bulls are going to move, and somebody's going to come out on top. But anyways, that's more theory than actual, analysis, and so we'll sideline that for that. But I'm happy to talk about that with anybody if anybody wants to reach out to me directly. All right, so moving on, we can see that the market did breach the 41.98 upper breach point. It breached it and then pulled right back down, came back into the range between the two breach points. We settled within the expected settlement range of 40.51 to 42.39. Did not come close to the lower breach point or to the parabolic SAR level as we expected. All right, so let's take a look now at the moving averages. Yeah, even though there's nothing new to report, I'm still going to keep this slide up here because eventually these colors will change. So contrary to popular belief, the market does not stay bullish all the time. These will not stay green forever. Just remember that. It's great when they are. Hopefully a lot of you guys are, making money in some of those, long-term investments that you may have in retirement accounts or things like that, which actually is something that I'm going to be talking about a little bit later. But right now, good times are rolling. Let's see how long they last. All right, so into the breach points. So the breach points for this week are going to be 41.60 and 42.07. Again, I intentionally left these where they were, with the scale to shrink the proximity of the breach points to the closing price so you could see just how close we're getting. Usually we have this slide and the price points are pretty spread out. You can see they're all clustered together, which again speaks to that consolidation of the volatility. And so even though volatility kind of went up a little bit, the fact is that we're not really moving anywhere. It's just kind of like up and down, and as such the breach points are actually getting closer and closer together because it becomes more and more likely that we're going to have a breach, to one way or the other. All right, let's add in the parabolic SAR. So your parabolic SAR went up to 39.33 this week. Again, ways away from the 41.60 breach point and the 41.74 close of last week. Let's add in the layer now for the expected settlement range. Here you see the expected settlement range still pretty wide, 40.66 to 42.54. We're a lot closer to the top side, which again, when I see big, gaps between these, first thing I think of is, what are the odds? Just looking at the amount of room that this market has to navigate and stay within these high probability ranges. Again, if these were 50-50 probabilities, I wouldn't put much weight in it. But the fact is that we've got almost a 79% odds that it's going to stay within that range, and above 80% odds that it'll breach one of those 2 points. So combined, I'm looking at, well, it definitely has a lot of room to breach the lower breach point and still stay within the expected settlement range. Whereas if it goes to the top side, it has to really, play that narrow gap to stay within the expected settlement range, which it doesn't have to. But again, all I go off of is what are the odds that this is going to happen. And looking at numbers, looking at the layout, looking at how where the price gaps are at, I'm seeing more of a tendency to breach that 4160 level and stay within the 40, above the 4066 level. All right, let's go now. Combine all these into the relative view. Again, you can see where the price is, how the two red lines are kind of closer together, and the green lines, being the expected settlement range, have a much bigger gap. And then all the way down there, lonely by itself, is 3933 parabolic SAR. All right, now let's have some fun. If you didn't see that one coming, pyramids in the sky. What do I mean by pyramids in the sky? And so what I'm going to do is put up a chart, and it's very similar to a chart I put up a couple of weeks ago where I showed the unsustainable slope of the price, increase. As you can see, it's just kind of going up, 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 and almost straight vertical. Well, it hasn't gotten any better since the last 2 weeks. In fact, it's only gotten worse. So look at this shot right here. All right, this is 1999 to present. You can see the two big downturns in our history here, recent history, 2000s, the Great Recession, then of course that big spike down, COVID last year. But look what it's done since. And last time we said that these angles were very unsustainable, this rate of growth, and that eventually we'd have a pullback. But this week I was looking at it and I noticed something pretty interesting, and I decided to have a little fun with some shapes. Now, this is not based on any technical, analytics. It's not anything based on the quantitative model. This is literally just looking at the price action and observing something that I believe is a pattern. And so the human brain is already geared towards pattern recognition. And unfortunately, there's also some bias in there. So I will throw that out there very transparently, that our own biases lead us to see patterns where others may not. But I'm going to share this pattern with you, and you do with it as you will. All right, look at these triangles or pyramids that are up here while we're in sky high territory, making all-time highs. We are sky high, right? And here are these three pyramids that I've looked at. And what's interesting is that every time we've had one of these pyramids where we're making new all-time highs, look what happens afterward. And so the market ends up coming back down, and not just to the bottom of the pyramid or the base of the pyramid, but it goes down even further. And so this is just the first layer I want to show you. We're actually going to zoom in a little bit more, and I'm going to show you some interesting patterns that I'm seeing within these pyramids. All right, so that first pyramid, you see that the market, went up, hit new all-time highs, and then pulled back down. Now, it did not stop at the base of the pyramid. It looked like it paused there for a second, but then it kept going down. Now, the red arrows at the bottom, just for some perspective for you, are the exact same height as the green arrows. Interesting, right? So the green arrows represents the distance between the base of the pyramid and the top of the pyramid, and the red arrows represent the distance that the market traveled down below the base of the pyramid until it reached a low from which it rebounded. Now, they're not exact, you have a little bit of white space there, but it's very, very interesting how close these things are as far as being, parallel or symmetrical. And then you also notice those orange pyramids. Those are times where the market did something else that was interesting. It created these smaller pyramids, but it actually came down to the base of the pyramid and then rebounded up. Now, the reason why I bring this up, you have about three pyramids right now that I'm looking at, which is the two yellow ones and the gray one on your top right screen, and then you have the four orange ones. Now, the gray one obviously is where we currently are at, and we have no idea what's actually going to happen next. But if we model this as the first half of a pyramid, then we have two probable scenarios, at least based on this pattern. the market's either going to pull back to the base of the pyramid like it has in the orange triangles. And in that case, our pullback target would be somewhere around 33.75. Again, this is rounding, very rounded estimate numbers. And then if it does follow the pattern of the yellow pyramids, then we're actually going to go down way further. And that red arrow, again, representing the same exact height as the green arrow, which means that we would end up coming back down to somewhere around 25.75. Obviously a much more drastic move, but if it's consistent with the pattern with the previous two yellow pyramids, then that is what I would expect just by observing this pattern. So again, this is more for your consideration. I would not start trading off of this, but just keep an eye on it. I really think that we're going to see the pullback at least to the base of the pyramid, and then at that point we'll see how the market reacts, because once the market's pulled back down that far, then you have gravity in play. You have the momentum toward the downwards, and that's why sometimes you've got that battle between buy the dip, or now you have all the sellers and you have buyers just being afraid to jump back in because they don't know where the bottom is at. Nobody wants to try to catch a falling knife. And I don't suggest that to anyone else either, but again, do not be surprised, right? Don't say you didn't see it coming if the market pulls back down at least to that 33.75 level. All right. In closing, I will share that next week I will be modifying the format of the show out of necessity, because my family and I are going on vacation. So we all need some time to rest. We need some time to recharge. And so I will still put out an episode with a brief recap of what's going on and the numbers for the next week, but it may not be with all the slides as well organized, and it may not be as long. It may just be a brief update to keep you guys on track going into the following week. But the quote of the week for this week is from Maya Angelou, who, again, like last week with Bruce Lee and some of the other previous weeks, it's not from a trader, but I think it can help you with your trading. So Maya Angelou says, each person deserves a day away in which no problems are confronted, no solutions searched for. Each of us needs to withdraw from cares which will not withdraw from us. I mean, we're in May, and I'm not trying to be, cliche with, sell in May and go away. Some people believe that wholeheartedly, but I believe that you should take time for yourself and recharge. You don't have to always be in the market. Being on the sideline is still a position. Like you still have a position. You can have a neutral position, and that's okay. You don't have to always be long or short. And so take that time to withdraw from those cares, because ultimately you'll come back stronger and better for it. So on that note, I wish you guys all a great week. I am looking forward to my recharge. I hope you guys find the time to do it for yourself as well. And I will see you guys briefly next week.